In the early 2010s, a flood of Chinese companies began appearing on the US stock markets. They promised rapid growth, huge revenues, and for investors, a chance to ride China's economic boom from the comfort of a Wall Street terminal. It looked like the next big thing until a few people started looking closer. In the aftermath of the 2008 crash, the US economy was slow. But as always, the investors, or rather the banks, were hungry for growth. They realized the need to look outside the US and were lured by China, the country that was exploding in growth. But investing in Chinese companies directly was almost impossible. Strict capital controls, opaque regulations, and a government that didn't welcome foreign scrutiny. Still, where there is a wall, someone finds a door. Enter reverse merger, a financial backdoor that allowed these Chinese companies to list on the US stock exchanges without the scrutiny of a traditional IPO. A private Chinese company would merge with a defunct, publicly traded American shell company. Instantly, they were public, and they get faster and potentially cheaper access to the public markets. Hundreds of Chinese companies took this route to become listed companies in the US. Now, with the stock ticker in hand, they needed credibility, and Wall Street delivered. Many of the small underwriters and B-level investment firms were now behind these companies. They organized investment conferences featuring high-profile figures to lend credibility to these companies. With several promotional activities and analysts pushing buy ratings, retail investors started pouring in money. Tens of billions of dollars were invested into these companies between 2009 and 2011, from hedge funds, pension plans, and retail investors alike. Stocks were doubling, conferences were packed, analysts were calling it a once-in-a-generation opportunity. Everyone wanted it. No one wanted to miss the next Alibaba. That is when the story starts to unravel. In 2010, Dan David was the VP at Geo Investing, helping clients invest in small-cap growth stocks, many of which were these hot Chinese companies. He recalls a moment when things stopped adding up. They said they had the factory size of a football stadium, but there were no photos, no videos, just numbers. Financials of these companies seemed too good to be true. Sometimes profits and revenue growths that even outpaced Amazon and Apple. There were glossy investor presentations, but no real-world verification. Dan David started with the basics and sent investigators to China. On ground, they expected chaos, operations, workers shouting, forklifts running. Instead, silence, empty gates, locked doors, a billion-dollar business that didn't make a sound. He compared the SEC filings with official Chinese filings from the State Administration for Industry and Commerce. Companies which listed revenue of $100 million with the SEC reported just $2 million with the Chinese authorities. It wasn't a rounding error. It was a lie. Dan David wasn't alone. Across the world, Carson, a former lawyer turned investor, was making similar discoveries through his firm, Muddy Water Research. They realized the books were cooked, the factories fake, and yet the stocks kept soaring because the illusion was profitable. Wall Street firms underwrote deals, auditors signed them off, investment banks pushed the narrative. Everyone got paid. Even when the truth began leaking out, no one wanted the party to stop. Dan and Carson released the exposes, published damning reports. In 2011, Carson accused Sino-Forest Corporation, a seemingly solid forestry giant, of being a fraud. The stocks collapsed, and billionaire John Paulson lost over $700 million. Other companies like Rhino International, China Media Express, and China Green Agriculture were also exposed in rapid succession. This was the moment investors could no longer ignore what was happening. One by one, the dominoes started falling. Dozens of Chinese firms saw their stocks plummet overnight. Many were delisted from US exchanges. Some CEOs vanished or stopped responding to investor inquiries. Confidence in all Chinese reverse merger companies, even the legitimate ones, started to erode. The SEC launched an investigation into how these companies got listed and whether due diligence had been conducted. Lawsuits were filed and class actions started stacking up. However, because of jurisdictional limitation, very few people were prosecuted and almost no money was recovered. The damage? Billions lost. Pension funds wiped out. Retirement dreams destroyed. But Wall Street moved on, and the system that allowed it stayed intact. This wasn't just a glitch in the system, it was the system, built on greed, enabled by complexity, and protected by distance. Today, new companies rise every week with bold claims. From crypto to AI to biotech, the hype cycle spins faster than ever. And the same question still haunts the market. What's real and what's a hustle? In the end, this was never about China. It was about a world too eager to believe in easy money and too slow to ask the hard questions. Remember, the next bubble won't look like the last one. It never does.